Hello again. Today is July 6, 2026, and this is your Monday Market Update. Hope everybody had a wonderful 4th of July weekend. While many of us spent time with family and friends celebrating America's 250th birthday, Wall Street quietly wrapped up not only a holiday-shortened week, but also the second quarter and the first half of 2026. As we begin the second half of the year, one of the biggest themes we've been discussing continues to play out. The market's leadership is changing. Earlier this year, it seemed like every rally depended on just a handful of artificial intelligence and semiconductor companies. Now we're seeing money spread into financials, industrials, healthcare, and other areas of the market. That's an encouraging sign because healthier markets tend to have a broader participation rather than relying only on a few stocks. Investors also continue to focus on three questions. Is inflation continuing to cool? Will the job market remain healthy? And when will the Federal Reserve make its next move? Add to that, what move will it make these days, right? Last week's economic reports helped answer some of those questions and gave investors a positive way to close out the first half of the year. Let's take a look at how the week unfolded. Monday started on a strong note as geopolitical tensions eased following continued diplomatic progress between the United States and Iran. That helped calm concerns about global energy supplies and allowed investors to turn their attention back to corporate earnings and the economy. Technology shares, especially semiconductor companies, rebounded after the previous week's sharp pullback, while several industrial and consumer companies also participated in the rally. There was a brief bout of volatility during the morning as the Japanese yen strengthened, creating some pressure in global markets, but buyers quickly stepped back in and the market recovered nicely. By the closing bell, the Dow had reached another record high, showing that this rally continues to broaden beyond just technology. The Dow finished up 0.5%, S&P 500 1.25%, and the Nasdaq up 2%. Tuesday marked the final trading day of both June and the second quarter, and investors continued putting money to work. Some of that was normal quarter-end portfolio repositioning by institutional investors, but there were some also encouraging economic news. The latest JOLTS report showed job openings remaining stronger than expected, reinforcing the idea that the labor market continues to cool gradually without showing signs of serious weaknesses. That's exactly the type of environment investors have been hoping for. A slowing economy, but not a struggling economy. The first half of 2026 also ended with some impressive numbers. The Dow gained nearly 9%, its best first half since 2021. The S&P rose almost 10%, while the Nasdaq gained more than 12%. Even more encouraging was the Russell 2000, which advanced nearly 22% during the first 6 months of the year. It's another sign this rally has broadened well beyond the largest technology companies. The Dow finished up 0.25%, S&P up 0.75%, and the Nasdaq up 1.5%. Wednesday was much quieter, but it reinforced the theme we've been talking about for several weeks. Investors continued taking some profits in many of the year's biggest AI winners while rotating money into the traditional sectors, including financials, industrials, and healthcare. Economic reports are mixed. Private payrolls came in a little softer than expected, while manufacturing data suggested inflation pressures continue to ease. Federal Reserve Chairman Kevin Warsh also struck a balanced tone, acknowledging that inflation has improved, while reminding investors that the Fed is still watching that data carefully. Even though the major indices didn't move very much, it was another reminder a lot can be happening underneath the surface of the market. Leadership continues to expand, and historically, that's been a constructive sign for long-term investors. The Dow finished down less than 0.25%, the S&P down 0.25%, and the Nasdaq was down 0.75%. Thursday wrapped up the holiday-shortened week with one of the most closely watched reports every month, the June employment report. On the surface, the numbers looked a little disappointing, with employers adding fewer jobs than economists had expected, about half as many, but the unemployment rate actually fell from 4.3 to 4.2, suggesting that labor market remains healthy even as hiring begins to moderate. That created an important reminder for investors. The market doesn't simply react to whether economic news is good or bad. It reacts to what that news means for interest rates. In this case, a slightly softer jobs report reduced concerns that the Federal Reserve might need to become more aggressive, and investors viewed that as a positive development. Once again, however, leadership looked different depending on where you were looking. Technology and semiconductor stocks continued to pause after their tremendous first half run, while investors kept rotating into financials, industrials, healthcare, and many of the more traditional Dow companies. That rotation helped push the Dow to another record close, even though the Nasdaq finished modestly lower. The Dow finished up 1.25%, S&P was essentially unchanged, and the Nasdaq finished down 0.75%. Looking at the week as a whole, it was another very solid week for investors after rounding the nearest quarter percent. All three major indices finished the week up about 1.5%. More importantly, the market enters the second half of 2026 with positive momentum, increasing market breadth, easing inflation pressures, and an economy that continues to show resilience. That's a much healthier backdrop than many investors expected just a few months ago. As we look ahead into this week, the focus begins to shift from the economic data towards corporate earnings. We'll hear early reports from companies like Pepsi and Delta, which should provide investors with an early read on both consumer spending and corporate profitability. On Wednesday, the Federal Reserve will release the minutes from its most recent meeting, which will give some insight to how policymakers are thinking about inflation and the path of future interest rates. We'll also continue watching the services sector of the economy, weekly jobless claims, and comments from several Fed heads. While those reports can certainly move markets in the short term, earnings season will likely become the primary driver over the next several weeks. As we begin the second half of the year, I think last week offered a valuable reminder. Markets don't always move higher because the same stocks keep leading the way. Healthy bull markets evolve, leadership changes, money rotates into new opportunities, and that's exactly what we've been seeing over the past several weeks. As always, if you have any questions about how these developments may affect your financial plan or your investment strategy, please don't hesitate to reach out. Thanks as always for watching this Monday's market update. Have a great week.